Hi, I'm Jimmy. In this video, we're going to look at the US economy. We're going to use different economic indicators to see if we can objectively gauge where the US economy stands today. And then hopefully we can answer the question, do we invest now or wait for the stock market to crash? Okay, so let's jump right in. So I've added a few different economic indicators this month around debt, specifically around debt for people and households. So our first indicator looks at household debt as a percentage of GDP. Now, I could find data going back to 1993. And as we could see, back during the financial crisis, well, household debt was super high, totaling almost as much as GDP did. Now, that's what the 100% line represents. That's 100% of GDP. So obviously, it doesn't have to be limited. It could go beyond 100% of GDP, but again, that's quite high. So clearly, the lower it is, the better. Now, things started looking good for a while, but then we had a decent spike as the coronavirus hit. Now, this spike can be caused by two things. First, obviously, is more debt. But also, you could get a dip in GDP like we had in 2020 with the coronavirus. Well, a dip happened, debt increases, so this number will end up being it'll go much higher, much faster than we might anticipate. Now, this chart actually only goes through the third quarter of 2020 because they haven't released the fourth quarter numbers yet. But I think that we can assume that with lower interest rates, debt is likely to continue to move higher. So when we switch over to our scorecard here, well, I think it makes sense to give this point to the bears, since clearly debt is a bad thing and certainly a future problem for households and for the country in general. Okay, now we shift over to a similar economic indicator in consumer confidence. Now, clearly, this one is going to be a point for the bears as well, since consumer confidence relative to its recent history is quite low. Now, I say this is similar to the first debt indicator that we looked at. I got another one coming in a minute. But I could imagine that as people's debt increases, as household debt increases, I would imagine they're going to lose some confidence in their financial standing and their financial ability to keep up with life and all of that stuff. So that's why I'm not too surprised to see consumer confidence on the lower end as it is now. Okay, now over to our scorecard. Well, now we get 2 points to the bears, since consumer confidence is also going to be a bearish point. Okay, now we shift over to a more macroeconomic factor for us to consider, and that is the yield curve. So this is a chart of the current Treasury yield curve, and this is going to be a point for the bulls, since this is a positive sign for the economy. Now, we also used the yield curve the last time we did the invest now or wait for the market to crash video, and we used it to illustrate how the yield curve works, but what I realized is I never really touched on why it works. So, in the last video, I showed this chart of the yield curve back in 2006. So this was leading up to the financial crisis. And this would obviously be a bearish sign because short-term interest rates that expire in the next few months, are higher than long-term interest rates. And this is a sign of overall weakness. And then we showed the yield curve for February of 2020. So this was before the stock market crash. And I got a great comment in the last video, and they said, are you telling me that the yield curve predicted a worldwide pandemic? And in replying to that comment, well, I realized that I never really explained why an inverted yield curve is a bad thing for the stock market. By the way, an inverted yield curve, that's what this is called. An inverted yield curve is when short-term rates are higher than long-term rates. And one of the ways that this could happen is that investors, bond investors, or banks or treasuries or banks or hedge funds or whoever it is that is buying treasuries, well, they start a flight to safety. So we might have heard the saying flight to safety. And basically what that means is that investors move their money out of riskier assets towards safer assets. Now, like it or not, treasuries are considered to be one of the safest of all assets. So when trouble looks like it's coming, money starts to be invested in longer-term treasuries. The longer term the problem looks like it could be, the longer term the treasuries go up. So this is what a flight to safety is. Well, as more money pours into longer-term treasuries, well, the yield on those treasuries begins to fall. Because we have to remember the relationship between price and yield. More people buy it, the price goes up. The price goes up, the yield goes down. So you end up with yields dropping in longer-term treasuries. Now, I could imagine not many people were concerned that the pandemic would extend 10 years out or 30 years out, which is why the very long-term treasuries did not invert. So the flight to safety, well, the yield curve ultimately, it warns us that big money is worried about stocks. So it's not that the yield curve was predicting the coronavirus or the pandemic. The coronavirus was already here when this yield curve happened. What it was predicting was that investors were worried about it. And had we seen this back in February of 2020, well, we would have been more aware that there was a big problem on the horizon. And we know a few weeks after this time period, well, the stock market jumped off a cliff. So that's one of the ways that this works. And I am oversimplifying this a bit, but generally, that's one of the ways we can look at it. Now, if we switch back to today's yield curve, well, we can see that this is looking positive. This is what they call a normal yield curve, and this is a positive sign for the economy in the near future. So back over to our scorecard here. Well, now we have our first point for the bulls. Okay, next up, we've got CEO confidence. So CEO confidence has remained fairly high and is likely a positive sign for the broader economy. Now, this one's a fairly easy one. We're going to give this one a point to the bulls, but basically the way this works is the Chief Executive Magazine does a survey of a whole bunch of CEOs to get their opinion on, or their confidence on, business conditions going out in the near future. They rate it on a scale of 1 to 10. CEO Magazine then takes that, averages them out, and that's what we end up with. We end up right now, we're at about a 7 out of 10, which is fairly positive. So back on our scorecard, we're at 2 to 2 right now. Okay, now sadly, we're heading over to some obviously bearish signs for the economy, and that is initial jobless claims is our first one. And clearly, this is way too high right now. And frankly, we need this whole level, this whole area to get back to where it was pre-coronavirus. So once it drops down there, I think we'd be much more likely to call this a bullish point. But for now, it's still way too high. We shift over to unemployment. Unemployment, once again, is way too high. Now, I do think it is a good thing that it's heading in the right direction, but as of now, the unemployment level is still too high to say that this is a good sign for the broader economy. So when we switch over to the scorecard, what I did is I actually made the jobless claims a negative point because we know that has to drop down to a lower level. But unemployment has continued to tick lower. So I made unemployment a neutral level. I made that a neutral point. So a point for the bulls and the bears. Now, I think that this is fair and hopefully somewhat objective. Okay, now we're shifting over to housing. So first up, we have home prices. And the average price of homes, and this is put out by the National Association of Realtors, well, the average price of homes is, as we can see, moving in the right direction. So this is going to be a positive sign for the broader economy and going to be a point for the bulls. And along those same lines, when we switch over to housing starts, well, this is how many new homes are being built. And once again, we can see that the number is in fact marching higher, which again is a good sign for the broader economy. So moving back to our scorecard here, we got 2 easy points for the bulls. Now, we got more houses being built, which is great, and we have housing prices going up. So hopefully not too many people are going out and borrowing against that housing, which could add to the debt problem. But again, we'll come back to that in a second. For now, let's shift over to manufacturing. So this is the ISM manufacturing indicator. And basically the way this indicator works is it all revolves around 50. Anything above 50 implies that there's growth in the manufacturing sector. Anything below 50 implies that there is negative growth in the manufacturing sector. So given the current level of this economic indicator, well, it looks like this is a positive sign for the broader economy. And over on our scorecard here, well, I think it makes sense to give this point to the bulls. Okay, now let's look at another consumer debt indicator, and that is 90 plus days or more late on credit card debt. Now, this one is a bit tricky because what it does is it tracks how many people or what percentage of credit card debt is late by 90 or more days. But I'm not sure that this chart, this data is really up to date. Yes, the last official data we have is as of the third quarter of 2020. But what I'm saying, I don't mean that it's not up to date, it's not in 2021 yet. What I'm talking about is that through 2020, the US government made it possible for people to cut a deal with the banks, basically, and postpone having to pay some of their credit cards. So it's very possible that many of these people that postpone their debt will in fact default in the near future. So I think that if anything, this number is going to be a bit too optimistic. I think the real numbers, might actually be worse than this. So clearly this is going to be a point for the bears, since in time, this is going to be a bad thing for the economy. So the question now is, do we invest now or wait for the stock market to crash? This is what our scorecard looks like. And for me, I think it makes a ton of sense to continue to invest as often as and as consistently as possible. But I do think it does make sense to strategically invest. I recently did a video where we talked about how the stock market looks overvalued. And with that being said, I'm not sure it makes a ton of sense to just go out and buy the broad market. But I do still believe there are plenty of individual investment opportunities that could be great long-term buy and hold stocks. And ideally, we dollar cost average these stocks or even ETFs. If we've been dollar cost averaging ETFs, I think we should continue to do that. That's a great thing. We shouldn't waste our time trying to time the market. But if we're looking for individual opportunities, I would stick with researching companies and trying to find the best possible stocks. Now, if we are trying to outperform the stock market and pick individual stocks, well, I actually did a video where I go through the 8 steps that I use to analyze a stock, and I tried to simplify the process for us investors. So if you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.